Hey guys, welcome back to the Results Junkies podcast. Paul and I did not coordinate this morning, so if you're not watching on video, thankfully you did not see that we are apparently wearing the Angel VC outfit this morning. So for those of you on video, you're welcome, and here we sit. We talked last week that we were definitely going to get to this Stripe crypto discussion, which we're absolutely going to do, and then we're also going to talk a little bit about some stuff that Paul surfaced probably over the weekend, maybe late last week, about how hard it is to get funded as a founder, but also the flip side of that and what it takes for investors to earn the sorts of returns that they need to keep this ecosystem going. Because I think, as you and I both agree, Paul, like this model only works for founders if the VCs have a reasonable shot at getting those sorts of outsized returns over time.
And it also needs to work for angel investors like us too. You know, it's if we're not making any money on this, we can't keep investing. So
right,
we all kind of need each other.
Yeah,
but.
Yeah, it's one of those things I've always mentioned to folks. They talk about, people talk about, founders always want valuations to be high, and angels and VCs always want investor entry levels to be low. But in reality, it's like the reason why you're trying to hit the sweet spot is because, the founder needs to be happy with the piece of the pie that they have. The angel needs to be happy with the piece of the pie that they have. And then further down the road, there has to be enough of the pie left over for whatever the exits are. And we're going to talk about those different philosophies here in a little bit.
Yeah. The more that founders try to understand how venture economics work, and you don't have to go to school for it. I think the more that even if you just took a cup of coffee and spent an hour reading about it, the more you know about how the money flows and who makes money and how it all works, I think the better you'll be able to understand why an investor might have said no, but also why they negotiate for certain terms that they need. It's like, I was just talking to somebody this morning, actually, and we were talking on the topic of term sheets. That's why I was late to this. But, one of the things I said is look, anybody can have $1 billion valuation. I can give you $1 billion valuation right now. You write the $1 billion valuation on the term sheet. I get to pick all the rest of the terms.
Yeah.
And then you can you can call yourself a unicorn. Totally easy.
Yeah, I'm going to go with no on that. You're on your own for that one.
That's probably Alex Adams' cue to make some sort of meme of me.
That's such a great transition. Just a little bit of housekeeping before we transition there. But show@resultsjunkies.com is how you find us. He is at Paul Singh on all those social media places, and TikTok still exists as of time of recording. And I am at Pizza in Motion on all of those same places. Going backwards to a couple weeks ago when we dropped that large file on Paul for that massive episode, our buddy Adam was nice enough to share a few memes. So if you're listening, there's some stuff to tune into on the video side. It'll be a YouTube link in the show notes. But this is his incredible his attempt at putting me in the box of shame, and not to be left out. He made sure to include you, and an absolutely epic use of a meme from the Casino movie.
I love it. I love this.
And who would ever put pineapple on pizzas beside me? So there you have it. Adam, I don't really know what you do with your free time, but apparently you spend too much of it making memes for us, because you also made sure to include Jeremiah here in this fun little excursion of paddling around his basement in a bucket.
We met Alex on the tech tour, actually.
Mm-hmm. Trust me, I remember, because I have pictures from him of you underneath your RV.
That's right. Yeah, and he's got a business, doing custom woodworking and stuff like that. Mm-hmm. But I'm going to sound like such an old man here, but basically between Alex Adams and my brother-in-law, I have learned very quickly that you either know how to create memes very quickly or you don't. I don't know how these guys do it. My brother-in-law sends me memes and I'm like, Dan, how do you do that? And he just, I don't know. Maybe they're just geniuses and we just don't know it,
Could be. So. And he's right on theme, because, in terms of your jealousy in recent episodes, my wife got me a couple more things for my background, which I haven't folded in yet, but he made sure to include this ever popular meme of you.
I love your backdrop, man. I'm telling you, I keep telling Dana that I want to redo my office and get some Lego F1 cars and airplanes and stuff like that, and just start making the background here. But yeah, I got a weird architecture, interior design crush on your office.
Well, yeah, and just to finally wrap up, and Adam, I didn't show all the ones you sent, because then we wouldn't have a show. We just have memes. But this last one of you reviewing legal document and then reviewing a summary from AI and falling off your bike and blaming it on Rob.
That's right. Yeah, poor Rob. No, he's not here to defend himself.
That's okay. That's okay. Lawyers are.
I still remember one of the best compliments Rob ever paid me, and it's like a backhanded lawyer compliment.
Mhm.
There was some document that we were going back and forth on, and I was like, "Look, here's how I think we should do it," or whatever. And he just I think he was on the phone, and I could just imagine what his face was. He said, "Paul, you come up with the most creative ways to close deals."
Yeah.
And I thought that was just such a nice, I still think about it. It makes me feel warm and fuzzy. That was such a, lawyer-like double-edged compliment veiled as a cut down or something.
Yeah, I can't imagine there's any way he meant that in a nice way, but anything's possible.
Yeah. We did get that deal done, but I got a compliment out of it too, so that was nice.
All right, well, let's talk a little bit about this Stripe story to get us started. And we talked a little bit about this last week. So Stripe is going to be supporting global stablecoin payments on their platform. And for folks who don't know, Stripe is one of the largest credit card providers in the U.S., or merchant banks, if you will. They provide merchant services for a lot of small businesses. We talked on the show probably about 4 or 5 months ago about Adyen, who's attacked the market from a different perspective. They've attacked it from starting with larger customers and moving to smaller, where Stripe started focusing on smaller customers moving to larger. This one was pretty high up on your list, and I'm curious to hear your thoughts, because I think when we initially discussed this, I was pretty sure we were going to disagree.
Well, first of all, the headlines on this are like Stripe and crypto, and I think most people understandably assume that anytime crypto is mentioned, that Bitcoin is the default coin. They're not really getting really speculative here. They're pegging it to the USDC, which is a stable coin.
Right.
But the broader, what do you call it? Like the broader, I think, implication here though is that this would be the first major multi-billion-dollar payments platform to accept crypto, and it could legitimize it. So I think it's pretty cool. And I remember when you and I talked about this. I don't remember exactly why we disagreed or why we thought we were going to be on opposite sides, but like the thing I like about Stripe is, I don't know if you've ever used their interface. You don't, just because they're able to accept like 87 different forms of payment doesn't mean you as a user of Stripe have to enable that payment form. So it could be that adoption's low when this thing rolls out. I just think the broader impact here is that, crypto's kind of becoming more accepted, and depending on how Stripe's PR team spins this, it could be the first time or the beginning of this idea that crypto could be accepted mentally, just like a credit card.
Yeah, and I think that's the easy inference here, is that this is a potential way to replace credit card transactions. I think a few things. First off, lots of entrenched interests at Visa, MasterCard, and the large merchant banks and things of that nature. So I don't necessarily think that this has a realistic chance to supplant Visa, MasterCard in any significant way. There's a bunch of legislation right now trying to work its way through the courts. So there's a big push that interchange fees are too high and all that stuff. And so Visa and MasterCard have agreed to temporarily lower interchange fees for a period of time. The reality is that I do think this will get disrupted at some point, because I don't know if you remember like the Dodd-Frank bill from a handful of, more a handful now, over a decade ago. So that was supposed to lower costs for consumers. And it actually ended up doing none of that. It saved merchants a little bit of money, but none of the money ended up in the pockets of consumers. Now, part of it, in a wayward way, sort of does, in that you get rewards, but for the person just getting a regular entry-level credit card, the merchants didn't pass on any savings that they got from Dodd-Frank in terms of capping interchange costs. What I think is more intriguing here is from a progress standpoint and from a development standpoint, what I think could be really interesting for smart founders trying to think about a way to leverage this is that what they're talking about here, set aside Visa, MasterCard for a second. To Paul's point, set aside Bitcoin. Don't think about those sorts of words. Think about this. If you've ever been in business and used a credit card merchant bank, you know that there's this big wall between you and the bank. And you swipe the card, and then a few days later, sometimes you get your money, and sometimes you don't, and sometimes there are chargebacks, and sometimes your numbers don't reconcile, and you call a faceless bank, and there's a lot of stickiness there. But the biggest one is it's friction, and you wait for your money. And I think what could be interesting here is Stripe is saying, instant settlement. And I think those are the key words here for folks. Not that stablecoin is a popular payment mechanism, but as a merchant, instant payment opens up a whole world of alternatives. BPNL, buy now, pay, or BNPL, buy now, pay later, is another philosophy in here. You start thinking about things like daily pay, which has become a big thing in the restaurant industry, in terms of it's almost like a payday loan, but offered through third parties, through your employer. These are all ways for people to get their money quicker. And you and I both know that there are more and more people that are starting their own company, even if it's just a side gig. And this idea of being able to have instant settlement and instant access to your funds, regardless of what the fees necessarily are, because I imagine the fees are going to be competitive or less than interchange, opens up this element of, if you can move the money quicker and it can be instant, then I think it opens up this concept of other industries that can help folks grow because they can get at their money quicker.
Yep. I mean, I agree with everything you're saying there. And I think the other mental sort of model or mental way to think about this is that, for most of your adult life and my adult life, credit cards were generally accepted.
Mm-hmm.
Right? Like there's never been a time where I threw down my Amex and a vendor said, I don't accept, I don't think I'm going to get paid. I only want cash. But we have to remember that at one point when credit cards started coming out, there was this mental hurdle that shopkeepers needed to get over, which was the difference between holding cold hard cash in your hand versus swiping a credit card and knowing you were going to get paid later on. And I'm sure it was bumpy rolling out. I'm sure there were people that were like, this is crazy. It's the mark of the devil, whatever. I'm sure there was all that. And that's probably where we are with crypto now, right? Is that crypto has probably been, at least in my opinion, has been a really great, or generally been for the major coins anyways, has been a pretty good store of value. But the ability to use it has been difficult. I can't really spend it anywhere. But see, the other thing I don't think people remember is Stripe actually did accept Bitcoin as a payment form back in 2014.
Oh, I didn't realize
they
that.
killed off that service a couple years later, but I think it was because the underlying coins weren't, pegged to anything real.
Mm-hmm.
Now that it's coming back almost a decade later, it's pegged directly to stable coins only. Anyway, conceptually, this is kind of like when people went from only accepting cash to learning how to accept credit cards. And now, whatever it is, decades later, this could be the beginning of people starting to maybe think of crypto, at least stable coins, in the same way they think of like me paying with Amex or Visa or MasterCard. So I don't know. I at this point, aside from all the operational challenges of the infrastructure and all that, I think it's going to be really interesting to see what their PR and marketing teams do around this. And then whether or not Visa and MasterCard and Amex eventually follow suit, I don't know. But
well, I think you're just making a little bit of an apples and oranges comparison there, in that I think Visa and MasterCard likely continue down their road for a very long period of time. They've moved into tokenization, things like that. And so I think of more of like something you said earlier about Stripe being the platform and stablecoin being one of the ways that the platform can process payment along with Visa and MasterCard. And I think of this sort of the same way. I think of Visa and MasterCard as the entrenched interest. I don't know that they'll choose a different form of currency for a very long time, if ever, in that what they're advertising to the market is that when you see their logos, that that you're protected. There are certain things that are built in there, fraud prevention, et cetera, et cetera. Yeah, and so like I think what they're selling this holistic model versus stablecoin is selling a much more stripped down, like I'm going to get the money from point A to point B without the other stuff. Okay,
so let me throw a curveball at you. I'm kind of curious what you say to this. So, and you probably, just given how much you know about points and miles and all that stuff, you probably know the right lingo here.
Mm-hmm.
But for me as a normal guy, when I go into my Amazon account, my Amex is connected to that account.
Yeah.
And somehow through the magic of technology, when I go to check out, if it sees that I have points in my Amex account, I know it's not a good use of those points, but it at least gives me the option.
Mm-hmm.
So in other words, Amazon sees enough value in that intangible set of points that I own to be willing to accept it as a form of payment, right? So here's the question now. I'm curious about your opinion. How long until, you know how when you log into your Visa or your Amex account and you like link a bank to make your monthly payments?
Mhm.
And again, I know I'm setting this up. It's going to seem like an apples and oranges thing, but like, how long until I'm able to log into my Amex or my Visa account or whatever, and instead of linking Navy Federal Credit Union, my bank, what if I'm able to, when will I be able to link my Coinbase account and maybe make payments from there?
So I think it'll be when there's an incentive offered, and it goes into a little bit about to your point about what the value of points and miles are, and you said it yourself. Using your points to pay for Amazon purchases is a bad value, and so what ends up
Yeah.
happening there is Amex builds, an interface with Amazon, and Amazon includes this as a payment method. Now, if it's just a regular credit card, I mean, there's not a lot of downside for sure to Amazon having another payment method, right? I mean, like it's just whatever the technology is to support it. But of course, Amazon, as we know, is always looking for ways to make money. And so Amazon actually works with those banks, Amex, Visa, places like that, to offer promotions for folks who want to pay with points. Why? Well, because if you use your American Express points for that transaction, American Express makes money. How?
Yeah.
Well, they're selling that point to Amazon essentially for a penny a point, but they're charging, so it's called a 1% rebate, but they're charging on interchange 3 or 4%. And so they're earning the spread there. And then what they're saying is, okay, Amazon, we'll pay you some marketing fee, and I don't know what that fee is, but we'll pay you some marketing fee, and we've got this this interconnectivity where I can show my points balance on the checkout screen and all that stuff, and I can get a customer to. And so with Coinbase, it's not that they couldn't do it today; it's that they don't have the same spread, if you will, on the transaction. They don't have that same
Yeah.
profit built in to be able to offer it.
Yeah.
So
Yeah.
all they
Yeah.
can offer really today are two things, and one of them is possible today. I mean, both of them are possible today. The first one that's easy possible is, hey, Amazon, we can offer Bitcoin as a payment method. And Amazon can decide whether that's a viable opportunity or not. But if I remember correctly, didn't Coinbase have a Super Bowl commercial?
They did.
Yeah.
Yeah.
So Coinbase could say, hey, look, we want to spend a portion of our marketing budget to promote Coinbase as a company. And so we're going to do the same thing that Chase and Amex are doing. And we're going to say, we're offering customers a 10% discount if they purchase with their Bitcoin. And so they could do the same thing today, but I think they need to offer Amazon an incentive to put it front and center. And that's what Amazon has done with these banks.
Yeah. Yeah. It's interesting. It's interesting. By the way, a little plug for your Slack group. So I finally got into your Slack
You
group.
did.
The paid community.
Yeah. Yeah.
I don't know how anybody gets any work done, but man, that thing is a gold mine. Everything from points to miles to just random banter.
Yeah,
People make fun of me.
Yeah,
So
well, that part's the best part. But yeah, if you wander around into like the "Wish You Were Here" thread, you'll see everybody's past vacations, places they've gone, pictures from the different hotels and resorts and activities and mountains they've climbed and all that stuff. So a lot of valuable stuff there.
yeah,
Thanks for the plug.
super cool.
All right, so let's talk about this. Let's talk about this relationship between funding and exits, and I'll include links to both of these slides in the show notes. So one is a slide from Carta that shows that in numbers, that this time period is the hardest time period for a startup to what we'll call quote unquote breakout, and it uses the conversion from seed to Series A on companies that were funded as part of Carta, so companies that use Carta for cap table management. And right now it lists those numbers, rolling into 2000 as, the lowest since, looks like this chart goes back to early 2018. And by a fairly big magnitude, with the numbers saying that seed to Series A companies were converting at a rate of anywhere from 20 to almost 40%. And as of 2022, that number had dropped to 12% of companies that were converting from seed to Series A, which isn't a huge surprise to me. But then the other thing that you noted, which I think again ties in very well, is this concept of how high a company has to go for us to make the sort of returns that we're making. And a VC named Martin Tobias, you referenced his tweet to me and about how this investment that he had that looked like it had gone up 15x was really only 5x because of a number of things behind the scenes, in terms of things that, most people listening have probably either heard of in passing one of these, but maybe haven't thought about the conceptual weight of these on a cap table. But things like, recapitalizing to make sure that the founders have enough shares, Something that's fairly simple when a company gets upside down, but what the impact is for that on investors is significant, if you will.
Yeah. Okay. So first of all, that the chart, I don't think it told us anything we didn't know, but it's always nice to just see, third party data visually explain or confirm what we've all experienced, that a lot of companies probably got seed funding that shouldn't have when times were really, frothy a couple of years ago. And eventually all those companies had to, go through that Series A, gate, and not a lot of them are going to pass through it. And
Right.
so it nothing was surprising with that chart, but it was just nice to see the visualization and the confirmation that it wasn't just, an individual bias or an individual viewpoint. On the other side, the when we talk about this idea of like how to make money in venture, whether you're an angel investor or not, and I'm going to preface this by saying that I'm not trying to sound like woe is me or woe is us, but I just want to like lay this out because I do think the more that founders understand how this business works, the more they're going to be able to understand why they are or aren't getting funded or why certain terms are getting negotiated. The thing is that on the exit side, I think we're all getting squeezed. If you were hopeful that you were going to get your money out of a company that got acquired by some other company, well, here we are in 2024 with inflation being what it is. And every buyer that has a little bit of cash is holding on to it, and rightfully so, because, right? I mean, it's just, it's you can make more money just parking it somewhere. So you're getting squeezed on that on the M&A side. That's just harder now. Then if you were hoping for some sort of, IPO, which we all agree is like really hard and the window's been closed for a while, but even then, if you were hoping for it, we also know that more and more companies have found other ways to stay private, whether it's SPACs or whatever. The fact is the IPOs aren't really happening and you got regulatory issues. Everybody just kind of doesn't want to deal with that. And so what's left is you're getting squeezed on the third front by private equity. I mean, those are the only folks I think that are left that have the capital to provide some of these exits. But understandably, they're not VCs, so they're not going to pay the speculative prices that VCs do. They're not going to pay future, value prices that public market investors might. They're going to pay on actuals, and I get that. I get that. So the point is, though, is that it's always been hard to return 10x in venture. It's just way harder now, and that shouldn't be a surprise to anybody. But again, I think founders need to understand that like that's the environment we're in, and if investors don't make money, there is no follow-on round. There's not enough capital left then to do 10 more deals, or so we're all kind of dependent on each other up and down the chain. But let me pause there because that was a lot.
It was a lot, and I think this ties back to the earlier discussion that we had about founders needing to understand how the various investors in their ecosystem earn money. Because I think the thing that this Carta chart doesn't necessarily incorporate is how many of these companies had some sort of an exit. So the group is 7,000 companies raising money. I don't imagine it's a big portion, but some portion of these companies likely got folded into something else, which isn't an atypical outcome for founders. And so you say like, well, how many of these just ended up at zero? We don't know, but ultimately, to your point of to be able to get from seed to Series A, you have to be able to convince an investor that you're going to return for them the amount of money that makes sense. And so a lot of companies, this is where we talk about, and we've talked about this a lot in the show, about the difference between a lifestyle business and an investable business. And you used to always say on the tour, I'm not sure this business is investable. And to that point, it's, hey, like if you bootstrap your company from a value of nothing to a value of $50 million and sell it, that's likely a great outcome for you. And if as an investor, as a seed investor, I invested in you at a $10 million pre-money valuation and you exit at 50, I'm probably disappointed because I needed to be able to achieve at least 10 or 15x on whatever my winners are in my portfolio to be able to maintain investing, as you said.
So you don't know which of your portfolio is going to return and exit,
Mm-hmm.
right? So what you're really aiming for conceptually is that every bet you make, at least at the early stage, and again, I should preface also by saying I'm an early stage investor, not late stage. So what you're really hopeful at the early stage for is that every deal you make has the potential for a 40x exit.
Right.
So 10x is nice, but realistically, if your hit rate is 10%, like if only one out of every one of your companies actually goes on to make an exit, well, then a 10x return just returns your capital.
Mm-hmm.
All other things being equal, right? And so that's the issue here. And I think I've said this before on the show. I think for early stage investors like you and me, we have to think about not only the deal selection, which ones are we going to do, but we also have to think about portfolio construction. And are there enough deals in this? Are we overexposed, underexposed, and all that? And again, I know we're getting into like inside baseball here, but again, I think not enough founders realize this. And so when they're like, oh, why did they negotiate? Like why do later stage investors negotiate a preferred return or participating preferred? Well, you don't have to look very far to understand that like they're worried about the downside scenario. You sold for, maybe they got in at a $30 million valuation and you sell for 35. Well, they didn't want to get treated like a bank,
Right.
and that I get that. So, and I will say, by the way, we do that. We get to the same thing with just a different way. Like I think in our open source docs on the 500 KISS anyways, I should say, on the convertible debt document, there is a term that actually says that we have a veto right if you accept any or try to accept any exit that returns less than 2x our cash.
Yeah.
Not because we're trying to block the deal, but because like we can't, you know where I'm going with this. Like I don't mean to keep harping on it, but it is harder than ever to make 10x, and it's only getting harder. And there was a tweet, I probably should have sent it to you, but there was a tweet that a Y Combinator founder threw out there this weekend that I thought was really interesting. Somebody congratulated some company on raising $4 million. And I think the founder of this YC company replied publicly and said, thanks. Our goal is to spend not a single penny of that $4 million. Which I know terrifies all the investors because they're like, oh my gosh, now they just parked it. But it's from a founder perspective, I think it's a very prudent thing to do. Just the more you can kind of focus on not just increasing spend right after a new round, it's smart. So
it's definitely a different direction than companies were taking in the teens though, because that was the goal. Yeah. It was, you raise money and you pour gasoline on something. And if that something didn't work, you picked a different something. And I think people, founders have to be more judicious about that because returns are being crimped. And I think, like if there's a takeaway here for founders that are listening, it drives back to this point that Paul made at the very beginning of the show, which is you have to understand just like you have to understand what your customers' intentions are and to be able to market to them, you have to be able to understand what your investors' intentions are. And in this instance, like I think if you read through the thread that Martin had on Twitter, which we'll include a link to in the show notes, you can see where, at least I'm inferring this, on top of the recapitalization of the option pool for the employees, there are a handful of times where it doesn't appear that he either had pro rata or chose to take pro rata, and that was what continued to work the value of his stake down. And so all those things are interesting and important to understand because they ultimately will help guide whether your investors are, in it for the long haul, if they're one round investors, all these sorts of things. And I think probably to the bottom line of it, you and I talk about how founders are, they're making hundreds of phone calls to close a deal. They're pitching hundreds of times. Well, if your company if your company is going to perform differently as it raises money than some, then you can include that information up front and early in a process and help investors self-select themselves out of your calendar. And I think that's why it's important to understand not only what it takes for an investor to make money, but the current investors you're pitching, what their thesis is, because it could be different from what Paul and I are discussing today, but they all have a thesis. And understanding that thesis, not that you want a no, but I think we always talk about you want a quick no. if you're going to get a no, so you can move on to someone who's a more reliable target.
Yeah. Well, I think, first of all, I also say if anybody still is listening at this point, as much as we've talked about the economics of this, just feel free to throw your questions out, whether it's on Twitter or email, you want to stay anonymous, whatever. But if there are questions that you want to know about, like why certain things exist, why certain terms matter, things like that, send it our way. Let's actually talk about this. Because like I said, this morning I was talking to another set of founders and we were talking about term sheets. And, it's wild, So much of this conversation about term sheets turns into like, oh, look at those like blood-sucking capitalists. They're screwing everybody. My viewpoint on this is like, show me the terms and I'll tell you what they're optimizing for.
Yeah.
Or show me the terms and I'll tell you what they're worried about.
Mm-hmm.
So let's see if we get anything fun aside from Alex Adams memes.
All right. Well, I think that's a good place to pin it.
All right, man. You going anywhere fun this week?
I think I am off of airplanes for one more week before things start to ramp up again. Can you believe it?
What?
2 weeks with no airplane tickets? Bizarre.
Good for you, man.
Bizarre.
Good for you.
Yeah, it's kind of weird waking up in the same bed every single day for like 2 weeks.
Oh, man. Don't get used to it.
I won't. I promise. I promise. What about you?
All right, buddy. Nope, not going anywhere. I always think there's always a chance I'm going to head down to Florida or something, whether it's Disney or checking in on Strata. There's always like some reason I'm sure that'll always pop up. But I'm trying to be like you. I'm trying to have an emergency trip to Disney as often as I can.
There's no rules about that. You just push the button.
Yeah. That's
although I will say,
yeah,
and not to bleed over into the other podcast, but if you go, maybe I'll throw a link to it in the show notes. But United right now, they tweaked something on their website. I thought it was this weekend, but a couple of folks have reported earlier. They ramped up their anti-bot technology for people searching award flights, which I kind of get. But if you go on United's website right now, you should try this. Go search like a handful of paid flights. Change the dates a couple times. Change the cities a couple times. United is actually shutting down paid ticket search. So what ends up happening after you make a handful of searches, it assumes you're a bot, even if you're logged into your account. And it starts returning a message that says, we're sorry, United.com was unable to complete your request, which is the message you normally get when flights aren't available. And so when I first saw it, I'm like, oh, okay, I wonder what this is. And then, okay, maybe the website's just having an issue. And then having talked to a bunch of people, this is actually currently a feature. So if you're searching for, like I was searching for flights back from Hawaii from our trip this summer and come back to Japan, and then I switched to Vegas for booking a work flight, and all of a sudden the site thought that I was a bot and stopped letting me search for some period of time. And it's like, I would love to know how many people are booking away from the website and how much money they're losing. Because there's two things there. One is maybe you still book a United ticket on a third-party platform, but now the third-party platform sells you insurance and car rentals and hotels.
Right.
Or, screw it, I can't get my ticket purchased on United. I'm just going to go book on American, and then you get nothing. So,
well, I'm a tech nerd here, and it's interesting that they would actually shut it down or display that message instead of what I'm used to on the internet, which is they display a CAPTCHA. If they think.
No CAPTCHA. Nope.
I mean, yeah, that's strange.
I'm telling you, I'm serious. Just spend a couple minutes trying to break it today. I guarantee you'll be able to.
All right, I will.
Challenge accepted. All right. Well, you have a great rest of your day.
All right, buddy. Talk to you soon.